Very unfortunate situation for the borrower to pass away, but because of some of these things Neal had mentioned, we were kind of ready to go on enforcement if we had to, just because of some of that spotty history.
Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal Andrino and Ryan and Neal. Enjoy.
All right, everybody, welcome back. It's episode 99 of the Canadian Private Lenders Podcast with your hosts Ryan and Neal. Neal, we're almost in triple digits, buddy. How about that?
That's insane. That's
almost 2 years.
Yeah, that went fast.
Isn't that crazy?
That is crazy. That went very fast.
And not only that, it's probably our last episode recording in this old studio.
Dirty
Your stomping grounds
studio.
for a long time, eh?
Yeah, where the other podcast started. I've been in here for 7 years, forever it feels like.
Wow.
Yeah, it was a good deal. At one point, it got really expensive really quick.
Where are we going next?
TBD.
Anybody want to offer us some studio space?
Studio space, office space. And by the time this comes out, it'll probably be too late. But
Yep.
if you had it, still let me know.
Yeah.
But it's funny. We talked about this in the last episode, but our marketplace has some really large landlords. I think maybe a disproportionate amount. And because of that, the pricing on stuff doesn't fluctuate whether it's empty or not. Like it doesn't. Supply doesn't seem to dictate pricing here.
No, it doesn't, which is kind of crazy, but we're learning that firsthand. We'll probably move to Riverside for a couple episodes, and then we're going to be on the road a bit in September, and then hopefully by October we'll have found a new home and hopefully a nice stable studio for the next 5 years, right?
Yep.
Let's do it. So today we're going to get into some of the dirty work of the business. We're going to go in depth on the first foreclosure that we faced at Keystone. So welcome back to the Canadian Private Lenders Podcast. Like I said, final episode in this current studio, but today we wanted to talk about this property we had to foreclose on probably 6 months ago now, Neal, maybe a little bit less.
Unique situation.
Yeah, and fortunately for us, we've only had to deal with one to this point. Not every lender is that fortunate, and I'm not saying we will always be that fortunate. It's part of the business at the end of the day, right? So it's something you don't necessarily want to go through, but
there's an interesting 100% part of it, and there's an interesting consideration. And when you look at things on a more macro level, when you're looking at like the metrics of the business's performance, no foreclosures suggests that you're not growing aggressively enough, and you're not actually utilizing your capital to its maximum.
Great point. I had someone early on in my time in the business saying if you're not foreclosing at, I forget what the number was, 3% or 2% or 5%, whatever it was, then you're not taking enough risk in this business.
Yeah.
Right? Because I'd say even the ones that you think are going to foreclosure, a lot of them just get resolved. Right?
Yeah.
Whether it's they find a way to come up with the capital or they sell the property in time or whatever, there's still avenues there even after the process has started. We'll get into details on this one and why we had to enforce on it, but a lot of those ones do end up getting resolved. But I think that's a great point. Is that it's not an ideal thing to go through, but it's a natural part of the business, and it's something you should expect getting into this business.
It's time to do some bad deals.
So we'll walk through what happened, how we managed it, and the lessons we learned, and how we use that to apply to future underwriting on other deals. Okay,
100%.
So do you want to kind of walk us through what led to the enforcement on this deal, Neal?
Yeah, for sure. So when we lent to Borrow, we knew, but they had a spotty payment history. So they had a bit of a track record of some late payments and NSF charges with us, and so they were a little bit of a higher profile file for us. Like we were watching them to ensure that nothing was going to go off, because when you miss a payment, you immediately get put to the top of the line for someone that we're going to see at the start of every month. We all are like, did so-and-so make their payment? And
I'll quickly add to that as well before you go any further that we'd actually said no to this deal originally. It was a really great broker partner that sent it in, and this borrower was a good friend of his. The deal was fine. We'll get into the details of it, but anyways, he ended up convincing us to do it. We just talked in the last episode about sticking to your underwriting criteria. Yeah. This is one we bent a little bit on, and it ended up costing us in some ways. But yeah, sorry to interrupt.
Yeah, no problem. And we were already into the business for a bit, so we did have a bit of a book again. This wouldn't, if this was the first deal, likely we would not have gone forward with it.
It was still relatively early, though. It
Yes.
ended up, taking a while, through renewals and whatever, but it was still relatively early and a deal we probably wouldn't do today.
And this is, I guess, proof of concept right here.
Yeah.
So then the next thing that took place that was kind of another huge red flag was the property insurance expired. And that's another thing that you need to ensure that insurances are in place. I think we talked about it. We have in the past.
We should probably do a full episode on insurance because it's just, I've talked about some of the examples I've had in the past, but it's something that I'm on like a hawk because it's just, it's tricky if
things happen.
Yeah, exactly.
And it seems like with some of these properties, there's a higher likelihood of fire or flood or whatever it might be, especially if they're not occupied.
Exactly.
So,
and it's often a telltale sign about the client's integrity that if they're not responding to you to get an insurance policy, chances are they're not going to respond when shit hits the fan with payments too.
And that was part of the case in the situation. So when their insurance expired, they were unresponsive in getting a new policy, and we were following up with them. And then this is kind of, I would say, the asterisk of this whole deal that you really, I don't know if it's something you can even expect.
No.
But unfortunately, they passed away. So their refinance was in the works and coming close. But
I believe it was the next day, if I'm not mistaken.
I didn't realize it was that close.
Yeah.
And unfortunately, the borrower passed away in advance of this, and they didn't have a will in place. So if there was a will, it might have been a little bit easier to get through the process.
Yeah.
But in this case, they did not have one, which meant we had to enforce. So really, looking at this, there's a couple different red flags that were there that should flag us. And honestly, I mean, I think they did flag us, and we watched the deal the whole time. I don't think there was, looking back on it, like a ton of time wasted or like an unexpected situation. We knew, we watched it, saw what was happening, and then it ended up taking place. But again, the reason it turned over is something that you can never predict. But
Yeah, very unfortunate situation for the borrower to pass away. But because of some of these things Neal had mentioned, we were kind of ready to go on enforcement if we had to, just because of some of that spotty history. So basically, we hired an experienced enforcement lawyer, and like this is number one. Like I'll shout out our guys, Grecky Carter in Toronto, again, our show sponsor. But these guys are leaders in the industry in this in Ontario. This particular transaction was in Nova Scotia, so we hired someone local here who's an expert in the field. But you need to have this in place and get this in place before this happens. Don't wait until after. Ask around. You can go we can go on all Nova Scotia or all Atlantic Canada, and you can see who the lawyers are, who are the banks using, right? Because those are the people are experienced and they've done it 100 times before, and they can jump on your file, right? So, build some relationship with some of these lawyers. You don't necessarily have to have one either. You could have multiple ones that you partner with for different transactions.
Still chasing lenders for updates? Manually entering deal details? Are you a law firm still not able to perform a discharge with just a simple button click? Well, Lawyer Automator is the modern solution built specifically for real estate law firms working with private lenders. Eliminate manual effort and automate intelligent document generation and digital instructions between lenders and lawyers with just a simple click. Enjoy seamless communication across your entire team and all stakeholders involved in the deal, from clerks to partners and everyone in between. Get comprehensive end-to-end reporting with visual business intelligence tools right on your screen. Perform discharges at the touch of a button. And because we're connected to Canada's largest private lending network, we'll even help you grow your client base with exclusive networking opportunities. Lawyer Automator. Work smart. Close fast. Grow your business.
At this point, it's not the time to try and save money. This process, trying to handle it yourself, you'll end up losing more in the long run. You're already going to be I know the mental state of I'm going to lose money potentially. All this is happening, blah, blah, blah. You want to get your best team working on this. Even if it costs you a bit more, your likelihood of success and reducing your loss chance is much higher that way.
Absolutely. Yeah, 100% right. Not the point to cheap out here. So, and you don't want to be managing this yourself. There's, we send out demand letters on our own, but even that, if you haven't done it before, just hire a lawyer to do it. Pay the hourly rate to get that done. You want to have this done right so that when the process plays out over the next 4 to 12 months, depending on where you are, all your ducks are in a row, and then when the judge looks at it, they say, yes, you're being awarded the amount you've asked for, right? And I'm not throwing out this out because you misworded this or you didn't include that fee or whatever, right? So basically, our lawyer walked us through the options on this. So in this particular situation, they refer to it as a simple foreclosure in Nova Scotia. go through the process. Basically, it allows us to accelerate the process a little bit here, but it bars us from doing a judgment against the borrower or the borrower's estate after the fact, should we not be able to recoup all of our principal and interest.
Yep.
So this one here, we knew we were well protected. We were around 50% loan to value. We're like, let's proceed. Let's roll the dice that we're going to be able to sell this property and recoup all of our money and accelerate the process. So, an accelerated process still took over 5 months to get through. I think it was closer to 6 months. The judge then awarded us possession of the property. And then, basically, the key takeaway here is make sure you build in these timelines when you go through the process.
Yep.
That's 5-6 months minimum. That's 5-6 months you're not earning a dime off that borrower, and you're still having to pay your investors during that time, or you should be paying your investors during that time, unless it's just not possible.
Yeah.
On a direct deal, maybe that's just not possible. But we're a MIC at the end of the day, right? So we're going to make those payments, but we don't have that cash flow coming in. So you really got to budget for that. And budget for delays.
We were super fortunate during the process to be able to gain access to the property as well. Mm-hmm. Sometimes that's not an option.
Absolutely.
Often, honestly.
Yep.
Yeah,
and that means you're not getting an appraisal of the inside of the property, and you're having to ballpark the value, right? So you don't actually know, you're going to be able to fully recoup your loan.
Which makes it risky. We had a fairly cooperative group that was working with us to get this finished, and
doesn't always go that way. I've had experiences where when you do finally get into the house, all the kitchen cabinets are ripped out, all the appliances are gone, and you're chasing your tail from the get-go.
Totally. People can, there's a million reasons and what happens. And I've bought foreclosures and had those experiences where you walk in and the whole place is demolished.
And I'd say that's probably more likely than, having the optimal scenario where you can just go in and it's kind of turnkey and you list it and sell it.
They don't usually move out and hire cleaners to clean it for you.
Yeah, no. Imagine.
So at that point, we were awarded possession. So we ordered an updated appraisal to confirm what its market value was. We wanted to ensure that we were getting the fair market value for that, and we also had intention to refund, the family, the additional funds. So we didn't want to try and shortchange anyone.
Yeah.
Sometimes you will see banks think it's a bigger process, but they'll just put the minimum number that they need to get out of it.
Yep.
But we were going to try and make the most of it. So we did that. We worked obviously with my team, fortunately, and we very quickly got on market. As soon as we had possession, how quickly were we on market?
48 hours max.
Yeah, I think 2-3 days we were on market. We had to get the photos, the marketing done. And so, we were able to get it sold, fortunately, with multiple offers and quickly, which was a dream. It's funny, looking back on that a little bit, just specifically to this, is during the deal, it's all the neighbors are so aggressively wanting to buy it. And then by the time it actually came to market, none of them showed up to the table to actually buy it. But they're all talking. When we went out there, I remember they would always come over and
the vultures.
They were like vultures, but my God. Anyways, we were able to get it sold really quickly, which is great. And we were really fortunate because of the way that we had lent on it. We were at around 50% LTV. So we were very well positioned to be in a safe place to recover our principal, accrued interest, fees, and legal costs, everything associated with it. So we were made whole. Again, stressful situation, but we were made whole, which was great. And the surplus funds were awarded back to the borrower's family and the estate. So,
and I think, one thing here, just from my personal experience as well, is that I would always recommend as soon as you get access to the property, as soon as you have possession of the property, don't sit on it, list it, sell it. If you have to make some minor renovations, sure. But
typically not.
Chances are, I've gone through the process before. We talked about it when Owen and Derek were on a couple weeks ago with us. We used to hold some assets. We used to renovate some to try to maximize the value, or we used to rent it for a bit. That's crazy. I would never do that anymore. There's almost no scenario that I would invest anything. I would list it as is, whereas get it listed, sell it. Unless you actually think you can chase it a bit and recoup your costs. Chances are you're probably not going to. You're just going to overinvest, and those costs are going to add up, and then you're still going to be ending up in the same spot with 6 months less time on your hands, right?
Are you a private mortgage lender in Ontario looking for trusted legal support? Meet Grecky Carter Professional Corporation, a boutique real estate law firm in Midtown Toronto with deep expertise in private lending and mortgage enforcement. Grecky Carter closes hundreds of private mortgage deals every year, and when recovery becomes necessary, they handle both contested and uncontested enforcement with precision, from forbearance agreements to power of sale and cost recovery strategies. For lenders who demand clarity, efficiency, and results, Grecky Carter has you covered. Visit gclaw.ca to learn more and safeguard your private lending investments.
100%. I think where you might see that more take place is in commercial lending.
That
or
makes
maybe
more
it's an
sense.
unfinished multi-unit building or something like that.
Totally.
And they have the experience or the team in place to be able to finish it. And they're like, if we don't finish this, we're going to take a massive loss. But if we finish it, we might be able to save ourselves.
And that could apply on a res deal if it was a construction deal and
Yep.
it was like, just the frame was up or something like that.
Yep.
But even that, chances are your exposure is probably pretty low if you've
Managed
done
well.
your draws, if you've allocated your draws properly
Yep.
and held them back. But whenever possible, offload the property as quickly as possible.
100%.
Okay. All right. So what are kind of some of the best practices for managing a foreclosure here, right? So first and foremost, understand the legal process in your province. So literally every single province is different here. Hire those good lawyers, get them to explain it to you so you kind of know how to anticipate the next one or, even before you have your first one and work with those lawyers hand in hand as soon as the problems start to happen. Okay. So on that note, hire a strong lawyer. Neal said it. Don't cheap out. This is going to be your safety net for making sure you maximize the return and recouping your loan. Okay. Have a robust mortgage commitment. Okay. So this is important from the get-go, right? And we talked about business planning in the last episode, but you want to have this from the start. Okay. So include those clauses. Assume the worst is going to happen. Okay, so include those clauses for default interest, enforcement fees, insurance requirements, and other covenants that are relevant to that given transaction. You want to make sure all your ducks are in a row on that mortgage commitment from the get-go because that's the document the client is signing, the borrower is signing, and that's the document that enforcement lawyer is going to use in a courtroom to ensure you get all of your capital back. Okay.
This is why I have bank commitments 100 pages now.
Exactly. And ours seems to grow regularly as well, but that's part of the business as well, right? So if you're talking a rental property, which is obviously much more common in an alternative in private lending, you're going to want to have an assignment of rents signed as well at the time of closing, right? So this can be valuable if you're enforcing on that rental property and there's still a tenant living there who's paying rent. Those rents actually get redirected to you as the lender. And it would actually help offset some of those costs. So that could be very beneficial while you wait for that long time frame as enforcement's going on. Okay.
That one's interesting to me because you see that they actually register that on title.
Yep.
As a completely separate. There's a commitment, and then that's a completely separate assigned.
Yeah. And so when a mortgage is completed and it's paid out, you actually do a discharge of mortgage and a discharge of the assignment of rents as well. So it's totally different. At least that's how it is in Nova Scotia, New Brunswick.
True.
Yeah. I don't know if that's the same across Canada, but okay. So we mentioned on construction renovation loans, but also take advantage of holdbacks. I know some private lenders, or I've heard at least some private lenders don't do holdbacks on construction loans. Crazy talk.
That is crazy.
Like, what are you doing, right? Most provinces in Atlantic are either 10 or 15% holdback for each draw that goes out. And the reason you'd hold that back is because you're going to have a bunch of trades and subtrades in there doing work, right? And then if they don't get paid for their work, they can slap a lien on the property, right?
Yep. The work's physically done, but not physically paid for.
Exactly. So that holdback protects you a little bit, that 10 to 15% buffer. And then after typically about when 60 days elapse, then the lender can then choose to release that to the borrower.
Yep.
Okay. And then, we talk about this all the time in private lending, but wherever possible, maintain low loan to values. Okay. So the lower your loan to value is, the better opportunity you have to fully recoup all your costs. And it protects yourself too. If the market softens, if there's delays in the project, values go down, you're much more better protected if you're at a lower loan to value versus being at 80% plus.
100%. So looking at this now, what could we have or what would we have done differently? So we've talked about it actually fairly extensively already, but the borrower had a history of late payments. So we maybe could have done stronger covenants or a higher risk premium. Basically, again, interest rate is a reflection of the risk associated with the deal. In this case, what we saw suggested that there might have been some additional risk. Maybe we charge a little bit extra to try and offset the potential loss situation that we may have ended up in. Insurance enforcement. This was a good reminder for us. We already did it, but we got even tighter on it, which is monitoring the insurances. Ryan has had some experiences in the past where they've had some really intense insurance claims and almost losses, we'll say. And so we always monitored it really well, but now we're even more intense with it because, again, you run such a high risk with that. But we also have an interesting opportunity. You can get a policy that automatically steps in place to cover in the event that your client doesn't have insurance or their insurance lapses.
Blanket coverage, yeah, basically, from a lender perspective. So if that borrower does lapse or doesn't get back to you in an appropriate time frame, you can actually place them on that forced policy and apply the interest to the property.
Which is an expense
mandatory to get it, I'd say, for a new lender setting up. Like, it was one of the first things we did when we set up our business, get this forced policy to cover blanket insurance on any of the properties you lend on.
100%. And then in this case, there was no will, so there's a risk associated with that. But again, this is why we lend conservatively, and it's something to consider in your mind. You don't know the full picture, and like you can't. That's not something you could ask about. Like you're not going to start underwriting and looking for people's wills to be submitted as part of their underwriting application. So you just need to be conservative in your lending, especially when you're starting out.
Yep.
So again, lessons learned: stick to underwriting fundamentals. We broke ours a little bit. Red flags early on in the loan. We need to be proactive and stay on top of that and make sure we take action where needed. And the nice thing is we didn't have any loss. So foreclosures are part of the business. Again, there should be a part of your business that is having those because you want to be in a position of growing to your maximum.
Yep.
But you got to be prepared to handle them. And if you handle them well, it shouldn't damage your business.
Absolutely. So I'll make another couple quick points before we do a quick wrap up here. But communication with the borrower, critical. We've talked about this a bunch of times. We tried to work with the borrower on this one, but didn't get any response. And we've seen this in multiple scenarios before. If they're not responsive, if it's insurance, you put them on your blanket policy, right? And if they're not responsive after they've missed 2 payments, start enforcement, right? Just get it started. Send a demand letter, get started as quickly as possible because it does take a lot of time. Consider all the carrying costs during the foreclosure. So you're going to have property taxes, you're going to have utilities, security in place, property manager, right? These can eat into your margins. If you're at like a high LTV, if you're in second position, like you could get into trouble with all this stuff, right?
Yeah.
And very important to include all of these costs on your final payout statement because you can't go chase it after the fact.
Yep.
And then, of course, there's the emotional side of it as well. This is our first foreclosure, right? So it felt like a big deal. It's like, like the world is crumbling. But if you handle it correctly, it's just part of managing your portfolio. It's part of our business, right?
It's one of the operations of the business.
Exactly. So that leads great into our wrap up here. But like foreclosures happen. Neal mentioned it. It's part of the private lending business. The key is to plan for them because they will happen, and plan before they happen, right? And that can be done by being conservative on your LTV, on your loan to value, getting solid documentation on your commitments, and dealing with great professionals on the broker side and on the legal side as well, okay? In this case, it all worked out for us. We recouped all of our principal and interest. But I've been in situations before where, you're lending 50% loan to value, but the property was only worth $100,000, right? And you got $30K of legal fees, and then you're in a small town and everybody knows about it, and the property sells for $75K or $60K, and then you're in a $15,000 hole, right? So that can happen. You gotta have everything kind of lined up to make sure that you're not going to take any losses, because that's the key, right? Is like foreclosures are going to happen. You're going to have to wait. It's going to take time. You're not going to have cash flow coming in during that time, but you want to make sure you get every dollar allocated when those funds do come back to you and you do sell that property. Okay.
It might be a little bit of a reduced return, but it's not a huge loss on your book. One thing I think to consider too that we haven't even talked about here is when there's a market downturn. Like that's often when a lot of foreclosures take place.
Yep.
And so you're at a heightened, like that's where time is even more important, because if the market's trending downwards, you're on top of accruing additional costs, the market might not be in your favor. Like we've been fortunate where it's fairly flat out here or up. That's an additional item just to consider in your costs that you got to watch yourself.
Absolutely. So if you're a private lender or private investor and you want to learn, how to prep your business for these worst case scenarios, you want advice in terms of who to go to for legal, feel free to reach out to us. We're happy to have a call. Maybe in our next 100 episodes, we create a mastermind group. Neal, I know we've talked about that a little bit, but maybe that'll be in the card before episode 200, but TBD.
Minds.
And just to wrap up, I know we've hinted at it before, but we're heading to the Canadian Mortgage Summit in mid-September. We're going to be interviewing a lot of great private lenders there, so make sure you check that out. And if you're at that conference, please do stop by the booth. We're going to be booth number 3.
The really cool couch.
September 17th with a really cool couch and a nice accent chair too. Anything else to add before we wrap, Neal?
No,
Last time in the studio, so...
Hopefully it sounds even better next time.
I hope so too, and we'll catch you all next time. Thanks for
guys.
listening.
Thanks. Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp. And Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan and Neal. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.